Good morning everyone and welcome to this month's HUBsights webinar. My name is Karen Arthur and I work in the marketing team here at Hub24. Today we're joined by Sam Morris, Investment Specialist at Fidante Partners. Sam will present accessing fixed income using active ETFs. So without further ado, I'd like to hand over to Sam.
Good morning everyone and thanks for the introduction, Karen. So as mentioned today, I'll be talking about fixed income as an asset class and how it can be used in a portfolio construction context, giving you an update on what's happening in fixed income markets, but also I'll be specifically talking about active ETFs and how this is a new access point for advisors and clients looking to access the asset class. So just before I get into the meat of the presentation, I just wanted to introduce you to who Fidante Partners is and what ActiveX is. So we're Australia's largest multi-boutique funds management company. We have about $60 billion of FUM under management, and that's spread across 13 independent boutique investment management firms in Australia and 4 overseas. So these are independent investment management firms. They're wholly owned by the investment staff in those firms, and the way we operate with them is we own a minority equity stake in these businesses, and then we help them with all of their marketing, distribution, compliance, middle and back office, product management and so on and so forth. So like many independent financial planning practices, which I imagine many of you are a part of, these are independent businesses that are very much aligned with their clients. ActiveX is our new active exchange-traded fund brand that's been operating since December 2018 when we launched the ActiveX Ardea Real Outcome Bond Fund, which you can find under the ASX ticker XARO. That was the first ETF in the series, and that invests in a unit trust from Ardea Investment Management called the Ardea Real Outcome Fund that's been operating since July 2012. We'll also be launching another active ETF in the next few months from one of our other large fixed income managers, Capstream, and that'll be the ActiveX Capstream Absolute Return Income Fund, which will launch under the ticker XCAP. So that's our business in a nutshell. But let's sort of get into the nuts and bolts of things. So what are active ETFs and how do they work? So the first point I'll make is that the exchange, the stock exchange, as opposed to the unlisted world of traditional managed funds, now has a very broad and deep array of product choices that you can choose from. So obviously there's the listed investment company and listed investment trust market, which is about $45 billion in market cap at the moment, and that's been around for a very long time. Then we've got the M-Funds product range, which is using the exchange to invest into unlisted managed funds, and that's about $1 billion. But the exchange-traded product range, or ETFs as they're better known, is now the largest product category in sort of the investment products set on the ASX and Chi-X. And that's totals about 198 different products as at the end of June, and about just over $50 billion in FUM. Now that can be broadly split into 2 categories. The first is your traditional passive ETFs. So the majority of the FUM is in those products, and they're your large-scale sort of low-cost passive products from the likes of Vanguard, iShares, State Street, and so on and so forth. Within passive, you can really divide the universe into 2 separate categories again as well. And the first is market cap weighted, so your very traditional index products where you're investing in a traditional market cap weighted index like the ASX 200, where your capital is deployed into the largest companies in the highest weights and it scales down from there. The second subset of what I would describe as passive ETFs is the smart beta universe, and that's where you apply a formulaic rules-based approach to investing, but you tilt those rules in a certain direction. So it might be you tilt the rules to invest in companies that pay a higher dividend yield, or you apply an equal weighting sort of portfolio construction methodology rather than a market cap weighted portfolio construction methodology and so forth. So that's a very fast growing category, and you see a lot of product issuers rolling out products quite rapidly in that subset. The second subset really is the active exchange traded fund universe, and they're sometimes known as exchange traded managed funds as well. And since the first product in that category was launched in 2015, that's grown quite rapidly to around 33 products today and just under $4 billion in FUM. And within that category, I divided into two further categories. The first is what I would classify as non-transparent active ETFs. So that's ETFs, active ETFs, where the underlying portfolio is not disclosed in full each day. So typically passive ETFs have to disclose the portfolio each day. But these products operate under a regime that is being reviewed at the moment by ASIC, where the portfolio composition is withheld to protect the manager's intellectual property. And what they provide instead is an indicative NAV or INAV, which is effectively an indicative calculation that's updated more or less in real time to give investors a sense of what the underlying value of the portfolio is throughout the trading day. And then these products also utilize what's called an internal market making model. So rather than having an external market maker, and I'll go through these concepts in a few slides' time, the fund itself buys and sells units with investors on the exchange, and the profits or losses from that activity accrue to the fund. So there's about 29 products in that category. The largest is a couple of products from Magellan that you may be aware of, and that's obviously growing very rapidly. The second category is what I call transparent active ETFs. So they're active ETFs that utilise the same kind of model as a traditional passive ETF, whereby the portfolio is disclosed in full each day, and in doing that, you can use external market makers to provide liquidity to investors. So XARO, the first of our ActiveX products, utilises that structure. Our future Capstream product will also utilise that structure, and there's one other product from a Beta Shares aligned issuer, BNDS, that also utilises that product, and that's a fixed income product as well. So how do active ETMFs work? Well, they're mostly the same as passive ETFs, except for a few sort of important differences. So the first, the way to think about it is you've got two components to the market. You've got the primary market, where units are created and redeemed directly with the fund manager, and they're done via specially authorised investors called authorised participants who can do that directly with the fund manager. And then you've got the secondary component of that, where you've got the on-screen component, where the units are being bought and sold directly with investors via the stock exchange. So obviously with any investment product, there's a product issuer and a responsible entity, and obviously the various support structures that fall off the bottom of that, such as the custodian, the registry, the administrator, and so on and so forth. But the important part is the green box here, and that's where the differences between the transparent and non-transparent models that I outlined earlier really show up. So if you've got an internal market maker, so the non-transparent model, basically the fund itself is the market maker and the authorised participant. So it is creating and redeeming units in line with demand from people on the exchange. And in doing that, because the portfolio is effectively not disclosed, they have to provide an indicative NAV or an INAV to give some sense of fairness to investors, so they know roughly what the true and fair value of the portfolio is. And then you've got the external or transparent market maker model, where effectively the portfolio is disclosed in full, like a passive ETF, and you have a whole ecosystem of external liquidity providers being market makers who essentially what they're performing is a retailing role. So they come to us as a product issuer. They might create large blocks of units. Typically a minimum creation size is about $500,000, but they often come to us for $1 million or $1.5 million chunks. They get those units off us, and then they effectively hold them on their balance sheet and sell them down in line with demand from investors on the exchange. Likewise, if there's a large redemption order that comes from the exchange, those market makers will buy those units off those investors and come directly to us and redeem them at NAV with us directly. So that's the way that plays out. And then obviously you've got the stock exchange where buyers and sellers meet, and then the brokerage platforms where investors input their orders as well. So that's how active ETFs work. So really getting onto just some broad educational concepts around fixed income and what role it should play in clients' portfolios. I guess it's useful just to go back to basics just to put fixed income in context. So when I think about it, there are really three asset classes from a legal perspective that any investor can invest in. The first and obviously best known is equity, so having an ownership stake in an entity. So obviously most people are buying listed shares, or they can invest in private equity, so obviously equity in companies that's not listed on an exchange. And I would classify property, even though it has different asset class characteristics, you're still, a legal equity owner in an asset, whether it's a residential property or a commercial property or whatnot. In the middle there, you've got hybrids. So obviously we're all familiar with the hybrids issued by banks in Australia, which combine elements of debt and equity. So they typically pay a dividend that sits above the dividends from equities in terms of priority to be repaid, but they don't necessarily have a legal contractual maturity date on when capital needs to be repaid. So in practice, most issuers of hybrids do tend to redeem and repay their capital at the scheduled, what's called call date, but legally they don't have to do that. So there is that risk that they don't necessarily repay capital in the event that their circumstances don't allow them to. So typically banks issue hybrids, but also there are companies that issue hybrids as well in Australia and offshore. And then obviously you've got debt, which is really what fixed income is. The largest asset class in fixed income is government bonds. I think there are about $60 trillion of government bonds on issue globally. And then you've got credit, which is essentially bonds and loans issued by corporates. Again, so you get some additional risk of not being repaid, which is called default risk. That gets compensated to you as a spread over and above the so-called risk-free rate, which is the government bond rate for an equivalent term of security. And then you get asset-backed securities like mortgage-backed securities or commercial bond mortgage-backed securities or thereabouts. So that's really just what we call a structured credit product, where a pool of debt assets is packaged together and the cash flows are spliced to meet different investors' needs. So where should fixed income sit? Basically, it's the defensive part of your portfolio. This graph here is just an illustrative graph to provide some a representation of different the different sort of levels of return in a relative sense from different asset classes. So you can see cash and government bonds are obviously at the lower end of the spectrum, moving up through corporate bonds into the higher risk parts of the fixed income spectrum. The purple line is where I've sort of decreed that that's moving into more, you're moving from fixed income risk into equity risk, and then you can see there property, global listed property, and Aussie and global equities and Australian small caps, and a sort of an approximation for how you should think about the returns from those different assets from an income perspective versus capital perspective. So that's roughly where fixed income sits on the risk return spectrum. So what should you expect from bonds in a general sense? I mean, first and foremost, fixed income and bonds in particular are meant to be a defensive asset class. And what I mean by that is you've obviously got your high growth asset classes like equities. Bonds have a lower expected return over the medium to long term. But what you should expect from bonds is that when the riskier growth asset classes are under pressure, so they might not be performing as well, you should expect bonds to be either performing positively or under less sort of pressure than equities. So they're meant to sort of limit the drawdown of in an overall portfolio context and provide that buffer against overall negative returns. So in doing so, bonds are supposed to provide consistent and reliable income. They're supposed to be capital stable, and obviously that comes from the fact that true fixed income has a maturity date, so a date at which you can expect capital to be repaid. And as I mentioned, they're supposed to perform in a sort of a negatively correlated way to equity, so an equity hedge, if you like. And in putting all of these aspects together, they should provide risk diversification to a portfolio. So really, when you look at fixed income, you get two traditional sources of return. And I might just go from right to left first and foremost, because the simplest way that you get a return from fixed income is you get what's called a coupon. And that's a sort of a holdover from, back before bonds were dematerialized. So now bonds exist in an electronic form generally around the world, just like shares do. But back in the olden days, when you bought a bond, you bought a certificate. And you would literally pull off a tab from that certificate, i.e. a coupon, and you would take that to an office somewhere. And in this case, you would present that certificate and you'd be paid the amount that's owed to you on that coupon. So really, when you buy a bond, you can expect a consistent coupon income. In a fixed rate bond, it should be a fixed coupon, and in a floating rate bond, that coupon will vary depending on some base rate. So it might move up or down with base cash rates or BBSW or LIBOR or some other measure of what short-term floating interest rates are doing. But in getting that fixed coupon, you take, particularly in the case of fixed rate bonds, you take a risk called duration risk, which is really the risk to your capital from changes in the risk to the capital value of a bond from changes in interest rate expectations. So the basic relationship is that it's an inverse relationship. So if yields go down, and you can see on my graph on the left there, if yields go down, the price of the bond should appreciate in value. So that's duration. It's basically a measure of the sensitivity of a price of bond to changes in interest rates. And in another way of thinking about it, duration actually sort of measures the weighted average amount of time a bond's going to pay back your initial investment. So, for instance, a 10-year bond, which has a 10-year maturity date, will actually have a duration slightly lower than 10 years because you're actually getting that coupon income along the way. So you're technically going to be repaid your, let's just call it $100, a little bit earlier than 10 years in a total cash flow sense because you get that coupon along the way. So actually duration will be higher, so duration risk will be higher for bonds that pay a low coupon rate. And obviously a bond that has a longer legal maturity date, you'll also have a longer duration there. But with duration, it's not a linear measure. So you also get this concept called convexity. And convexity basically measures the change in duration for a change in interest rates. And it basically means that a bond's price with respect to expected interest rates can be thought of like a curve. So for a shorter dated bond, it's going to be a much straighter line, and that relationship's going to be a much more linear relationship. But for a very long dated bond, and in this case I've just used an example of a 100-year bond, it's actually going to be a very sharp curve. So what that means is that the longer the bond's maturity date means you're going to get a higher appreciation in price for a given sharp downward shock in interest rates than you would for a shorter dated bond. And it's worth just sort of pointing out a few fun facts about a 100-year bond. You might think who on earth would stick around and own a 100-year debt security? But the reality is actually increasingly as interest rates globally have fallen and investors have been desperate for yield, actually a lot of companies and corporates have been able to get away with issuing 100-year bonds. So actually Austria only a few months ago issued a 100-year bond to investors, and they're going to pay investors a total yield over that period of about 1.2%. So putting your money away for 100 years and getting 1.2%. In Australia, it doesn't sound very compelling, but if you're in the European Union where the majority of government bonds now trade at negative yields, that's actually reasonably compelling. A couple of French utility companies have issued 100-year bonds in recent times, and actually it was only a couple of years ago that Argentina issued a 100-year bond. And Argentina's defaulted 8 times since its independence in 1816. So, you're taking quite a bit of credit risk in buying a 100-year bond from Argentina. So anyway, just a few fun facts there about 100-year bonds. But that's the basic dynamics of the risks and returns you're taking in fixed income. Now, adding on top of that, you've got credit risk. So obviously, if you invest in a corporate rather than a government, you can expect that there's a higher probability that corporate may not pay your money back. Now, even if there's a very remote risk of that not happening, markets still price in a probability of that potentially happening, and that's called a credit spread. So that's an additional amount of kind of extra income or yield over and above what risk-free assets like government bonds have for that, the given maturity of that debt, and that's the compensation you get for owning corporate credit. Now, obviously, credit ratings have a very wide spectrum. The least risky securities are AAA securities. The Australian government's rated AAA. There are very few corporates around the world that are rated AAA, and increasingly a lot of governments around the world are not being rated AAA as they've leveraged up their balance sheets. But really the important thing to note is that down at that BBB minus level, that's where you get a sharp shift in credit risk, because you move from what's called investment grade to speculative grade or junk bonds, basically, or sub-investment grade. They're all the different terms that are used to describe that. And at that point, the way default probabilities work is you get a sharp uptick in the historical realised default rates between those two rating categories. So you can see on the right there, I've just shown a graph from S&P that shows how default rates globally have trended between the two different types of credit risk, whether it's investment grade or speculative grade. And you can see that investment grade credit, the default rates are generally very, very low, with maybe small spikes in and around periods of economic stress like we saw in 2008 or 2001 or the late 1980s, but generally very, very low. And then you can see speculative grade is much, much higher than that. So the other point to note is obviously, like all asset classes, credit is cyclical. So and I guess the main point is there, when defaults hit, they tend to hit en masse, and they tend to hit certain sectors a lot harder than others. And we saw that, say, in 2016 when the oil price collapsed, and in the US, a lot of kind of the energy producers down mining the shale oil and shale gas in the southern states of the US suffered quite heavily, and there was a lot of defaults in that sector. So it is a cyclical thing. So you need to be careful about where you're putting your money into credit with respect to the economic cycle. The other point I'll make is also that investor mandates often dictate whether they can hold investment grade or sub-investment grade. So that changeover point is a critical one, because basically a lot of investors invest the mandates their investment managers have, whether that's a passive mandate or an active mandate, often stipulate that they can't hold sub-investment grade credits. So if credits move from investment grade to sub-investment grade, there can be forced selling that happens, and that's called fallen angel risk. Fallen angel being a formerly investment grade company that's fallen to a sub-investment grade rating. So that's a risk to be careful of, because basically increasingly corporates around the world have been leveraging up their balance sheets, and in the US now, over 50% of the investment grade credit market is now at the very lowest rung of the investment grade credit market, so that BBB range. So if economic conditions were to deteriorate, it's feasible that some of those companies would tip over to being sub-investment grade credit ratings, in which case you'd get forced selling, and basically investors could expect price falls that would be exacerbated by that forced selling. So that's just something to note. So I guess what I'm getting at is that active management is more important than ever, because you need to, fixed income markets have a lot of inefficiency, so there's a lot of opportunity to capture inefficiency, and I'll talk about one strategy that does that in a second. But also from a credit perspective, you need to be very careful about where you're putting your money to obviously get the best possible yield for the lowest possible credit risk. So the first point I'll make is actually there's been record inflows into the fixed income asset class over the last year. We've actually never seen more money flowing into fixed income than we have over the last 12 months. And that's at a time when bond yields are at record lows. And in fact, 25% of all developed market government bonds now traded at negative yield. So there's a lot of money that's been chasing this dynamic as yields have been falling, and obviously that delivers positive returns to fixed income holders. But the broader question is, how sustainable is that trend of chasing that return as yields drop ever and ever lower? Yeah, so that's just one caveat about sort of investing passively, I suppose, in fixed income. And to sort of put that in context, in the Australian market, we've got here a graph showing two things. One is the index yield, so the income return from investing a new marginal dollar in the index in green, and then we've got the duration of the Australian government bond index in blue. And you can see here that the difference between the return you're getting, the yield, versus the risk you're taking has never been wider. You can see here back in 2008, where you were getting yields above 7% from investing in a government bond index and duration of about sort of just under 4. Since that period, duration risk has risen over 65%, whilst yields have fallen over 82%. So to put that in, say, an equity context, that's like the PE ratio of the Australian government bond index rising from about 17 times to over 71 times today. So it's a massive re-rating of the asset class, and that's obviously benefited investors who've ridden that. But the question is, with yields so low now, how sustainable is that? Another sort of way of looking at it is that the current index yield of 1.4% and a duration of about 5.5 years, I should say. If yields rise by just 25 basis points, so 0.25%, it wipes out your annual interest income from a capital loss perspective if that move were to happen. So you're taking a lot of directional risk at the moment. And if yields were to back up to the levels they were at just in December last year in 2008, the loss of investing in the index would be about 6.5%. Whereas to gain 6.5% in additional kind of capital return, if you like, from passively investing in Australian government bonds, the yield would have to fall to about 0.2%, so almost zero. So that's a sort of a fairly depressing outlook in my mind from investing passively in government bonds, and those dynamics are worse overseas, I should add. We actually got it pretty good in Australia. But a different approach is to investing in the asset class is to, rather than take that directional risk and just buy everything and hold it, is to take what's called a relative value approach to investing. And basically what that means is, rather than taking directional risk on whether rates rise or fall, what you're doing in a relative value approach to investing in bonds is you're looking for market inefficiencies. So similar securities with the same or nearly the same risks that are mispriced relative to each other. And I'll walk you through an example of that of the next slide. It works best with government bonds because government bonds are highly liquid, have very low trading costs, so you can constantly rotate capital to identify and trade into and out of opportunities, versus, for instance, credit, where you've got higher trading costs. But the result of investing in this way is you get a return stream that's independent of the level and direction of interest rates. So this type of investing works in a negative interest rate environment, a positive interest rate environment, whether rates are falling or rising, it doesn't matter. And you get an investment style that benefits from higher levels of market volatility. So if there's more volatility and mess in markets, there's more mispricing to capture, and it benefits this style of investing. And then the end result of that is you get a return stream that provides diversification to traditional sort of more benchmark aware government bond, credit, and even equity investments. So that's relative value at a high level. Just to give an example of how it works, basically one type of relative value opportunity that Ardea Investment Management through XARO look at in the Australian market, and probably one of the simpler relationships they take advantage of, is rather than sort of buying or selling government bonds, what they'll do is look for situations where large investor flows cause particular bonds to basically fall in value compared to bonds that are on either side of that specific security. And they'll look to sell, so go short a similar length futures contract. So in this case, I've used a 10-year government bond and a 10-year futures contract. And what that takes advantage of is the fact that you've often got very different types of investors trading those different instruments. So traditional government bond investors like passive index funds, even banks have to hold government bonds on their balance sheet at certain times, maybe trading those instruments independently of what's going on in futures markets, where offshore investors like hedge funds and the like might push, and that relationship frequently gets pushed out of alignment. But you can have a very high degree of confidence that that gap, if you like, will converge, because bonds and futures contracts legally, just by their nature, will converge at the maturity of the futures contract. So to illustrate what that looks like, that's just on the right, a graph of the 10-year government bond yield and how much movement we've seen in that over the last sort of 15 years or so. But that's the same, the relationship on the bottom dark blue line, the relationship between the 10-year bond and its equivalent futures contract is very, very tight. It's got a very, very narrow basis, as the sort of technical parlance would call it. And occasionally that moves out of alignment, where you see those sort of small blips. So what a manager like Ardea is looking to do is capture those blips and lock in a very low risk, diversified return from doing that. Just to talk briefly about credit. So, you know, the importance of active management in credit's never been more important in my mind. And credit does offer you a pickup in yield over government bonds. So here's a graph from Capstream Capital, and I've mentioned the ETF will be launching of their long-standing unit trust strategy they've been operating in Australia. But you can see there that compared to Australian government bonds, A-rated corporates and BBB rated corporates in Australia do offer a fairly decent yield pickup compared to the equivalent government securities. But you can see here that the difference between that A-rated yield and that sort of that higher risk BBB rated yield is quite tight at the moment. So there's a lot of impetus in sort of Capstream's mind that from a risk reward perspective, you're better having the higher quality credit than the slightly lower quality credit at the moment. But just to put credit risk in a global context, as I mentioned, in the US, over 50% of corporate credit now is rated at the very lowest rung of the investment grade corporate credit spectrum. And also just looking at US investment grade credit, broadly speaking, the metrics in terms of the amount of credit outstanding, so how much debt US corporates have, the gross amount of leverage that they're holding, and their ability to service interest is now at worse levels in an aggregate sense than just before the global financial crisis. Now, I'm not suggesting we're about to go into another global financial crisis, but it just suggests that the amount of leverage in the system has grown a lot. So you really need an active manager who can pick through that and find the best value for the least risk, rather than investing passively and buying all of the credit risk in one go. Just to conclude, credit's a cyclical thing. So this is so on the left here, this is just showing what 2018 defaults were versus the long-term average, and this is a global sense. So at the moment, sort of energy and natural resources companies are defaulting at higher levels than their long-term averages suggest. But a lot of industries there, typically the less cyclical industries, financials, and so on and so forth, are sort of defaulting at lower levels than their historical norms. So compared to say investing in the index, you've got to be quite selective about the industries that you're investing in. From Capstream's perspective, they see good value in Australia. Over 2/3 of their portfolio is invested in Australian credits, and they see better, you know, although increasingly they're seeing some value in the US, and they're staying right out of Europe at the moment because it's a very uncertain situation there. And you can see here their sector allocation is heavily weighted towards financials. Globally, the banking sector, particularly in the US, but also Australia, is much better capitalised than it's ever been, and the regulation around the risk they can take is much higher. Whereas, you know, there's still a lot of doubt about you know, the risks of European financials, particularly in places like Italy. But also Capstream are heavily weighted into you know, utility stocks like infrastructure assets and the like, where the cash flows are very stable. There's good underlying collateral and much more predictable credit risk. So I guess the only point, the concluding point I'd make is that the importance of active management and sector and issuer selection versus sort of buying the index, which has traditionally been the only option you can have in ETF land up until recently. So that's the conclusion of the presentation. And yeah, welcome any questions.
Great, thanks, Sam. So it looks like we had a couple of questions come through during the presentation. Apart from what you've outlined, are there any other major risks in fixed income markets that we should be aware of? Yeah,
that's a great question. Look, I think obviously one of the risks I think that's underappreciated in fixed income, particularly in corporate credit, is liquidity. And liquidity is just the ability to trade at a decent price when you want to. And what's been happening in corporate credit markets is that since the GFC, banks have been pulling out of supplying liquidity to corporate credit markets. So the way fixed income trading typically works is that banks are required to intermediate buyers and sellers. So if you're a fixed income fund and you want to sell a corporate bond or a loan, often a bank will take that trade onto their balance sheet, and then they will find a buyer later on and hopefully not take a loss on intermediating that trade. Now, since the GFC, the amount of capital that in the US at least that investment banks have applied to that activity has dropped from about $300 billion in balance sheet capacity to near zero today. And what's the driver behind that is predominantly regulation. So as regulators have endeavoured to make banks safer and so they hold less risky securities on their balance sheet, corporates have pulled back from doing that activity, and there's basically a lot less liquidity. So if in the event that a whole lot of corporate credit investors wanted to rush for the market at one time, particularly investors in kind of riskier corporate credit securities, so sub-investment grade would be a good example. We haven't yet tested what that would look like, the ability for that rush to the exits to be facilitated by the banks.
Great, thank you. Just another one. What has the performance been for the Ardea and Capstream strategies?
Yeah, sure. So we've got, just if you don't mind, I just want to make sure I give you the right numbers. So Ardea's been operating since July 2012. Since inception, that strategy's after fees, and I should say that the ETF has the same fees as the unit trust, has generated a net return of about 4.1% since inception. But over the last year, we've seen returns of about 7.4%. And that's really a function of the higher volatility in markets and the fact that there's more opportunity for that relative value style of trading. And that's been achieved with taking no credit risk, so no exposure to corporate debt, and no duration risk. So it's all about exploiting that mispricing. From a Capstream perspective, that strategy's been around for a long time, since about 2007, and since inception, that's delivered a return of 4.8%. Over the last year, that's delivered a return of just under 3.5% after fees. And that's really a function of taking exposure to very high quality, very liquid corporate credit, and delivering a return that from the stable coupon income that those corporate credit pays. So that's been what recent and long-term returns have been like for both of those strategies.
Great, thank you. One last question. Does the underlying investment process target a particular income outcome, or returns mainly come via capital gains?
Yeah, so I think the return streams from both products are slightly different. So Capstream is very much about generating a stable income and minimising downside risk through good credit selection. So you can expect the returns to come out of that predominantly from the coupon income. Ardea is a different strategy. It's about frequently trading to capture those relative value opportunities. So that ultimately is paid as income, but a lot of that the way that return is generated is from sort of capital appreciation through the convergence of those types of trades that I talked about earlier. So it's not so much about collecting the coupon income from the underlying bonds, whereas Capstreams is about that.